Hi, everybody. Thank you all for joining us today for our webinar on reverse 1031 exchanges. Today, we have Senior Vice President of Midland 1031, Teresa Noer, as the speaker. She is currently a CISP, which is her Certified IRA Specialist Professional designation. And then she also has her CES, which makes her a Certified Exchange Specialist. So if you do have any questions, we ask that you type them in the questions box. Do not type in the chat box. We don't want to miss the questions. So please try to type them in the questions tab. Other than that, take it away, Teresa.
Well, good afternoon, everyone. Thank you so much for joining us today. As Brenda mentioned, my name is Teresa. I oversee our 1031 exchange division here at Midland. Very excited to talk to you today about reverse exchanges, which is something that isn't necessarily as common as your typical or standard exchange where clients sell their property first and then buy the new property. So I hope that you all are able to take away some good little nuggets of information today. A little bit about Midland and Midland 1031 specifically. Midland is a self-directed IRA administrator and a qualified intermediary for tax-deferred exchanges. Our main offices are in Chicago and in Fort Myers, and our trust company, Midland Trust Company, is based in Sioux Falls. Specifically about our QI services, we have been a local QI since 1997. And we are proud to have 2 certified exchange specialists on staff, myself and our fearless leader, Dave Owens. We try to pride ourselves on providing personalized service to our clients, and I think that that's something we are constantly working towards and trying to provide to people. As a QI, it's important to also note we are bonded and insured. And while we do not give any sort of legal or tax advice or investment advice, our offices are operated by individuals with backgrounds in both the legal and tax fields. So we are really looking to provide educational content for people or information to clients and their team so that they can make informed decisions. So I hope today is going to be a day where I give you some useful information. So why are we here today? I'm going to show you 2 things. I'm going to show you how it is possible to buy first, then sell, and still take advantage of a 1031 exchange. And then I'm going to show you how you can utilize a deferred and a reverse exchange in order to maximize the tax deferral. So before we dive in, I wanted to give you a quick refresher on what a 1031 exchange is and who can take advantage of this strategy. So 1031 is a section of the tax code that basically allows a taxpayer selling investment or business use property the opportunity to defer the taxes that would have applied, provided that they follow a few simple rules. And I have those rules on this screen right here. First and foremost, the property sold and purchased must be investment or business use property. In other words, no primary residences or second homes. It's got to be investment or business use property. The second rule is you've got to use a qualified intermediary, which is what we are. The sole function of the QI is to facilitate the exchange, and that's it. So what that means is the taxpayer himself or herself cannot act as their own QI, nor can anyone that's acting as an agent of the taxpayer, such as their attorney or CPA or even their realtor. Third rule is that they have to purchase property that is at least equal to or greater than what's known as the net selling price of the relinquished property. That's a fancy way of saying it's the contract sales price minus your standard costs of closing, such as realtor commissions, title fees, the exchange fee. Okay, one thing that is a common theme in discussions that we have with people is they often confuse net selling price with net proceeds or profits. For example, it really comes down to net selling price. If you want to defer all of the taxes that would apply to the transaction, it is based on the net selling price, not just the profits and not just the net proceeds. There are 2 deadlines involved with completing an exchange. You have 180 days from closing on the sale to complete the exchange, and you have to identify your target replacement properties within the first 45 days of that 180-day period. Those are the basic rules of completing a standard exchange, just so everybody kind of has a little bit of background on what an exchange is and what it takes to complete one. Who can take advantage of a 1031 exchange? Anyone that's selling investment or business use property. So it could be an individual, a corporation, a trust, you name it. It really comes, whoever's selling the property can complete the exchange. When we are speaking with prospective clients, the question inevitably comes up, is it possible to buy first, then sell, and still somehow utilize the 1031 and make it work? Well, Revenue Procedure 2000-37 says yes. This revenue procedure gives us the framework for completing what is known as a reverse exchange. So what is it? In 2000, the IRS issued Revenue Procedure 2000-37, and it basically gave some additional provisions for taxpayers who weren't able to complete a standard or straightforward deferred exchange. It gave them the opportunity to buy first, then sell, and still enjoy the benefit of a 1031 exchange. So how that works is the qualified intermediary would establish an entity known as the Exchange Accommodation Title Holder entity. And it would basically take title to one of the properties and hold it until you sell your existing property. So let me walk you through that process. When is a reverse exchange an option? Usually what happens is the taxpayer or the exchanger has found the ideal replacement property before having a buyer for their relinquished property. In a perfect world, they would sell first and then purchase, and it's nice and clean and easy. But no matter how meticulously you plan things out or try and prepare for things don't always go according to plan. So it gives them an opportunity to lock in the replacement property before closing on the sale of their existing property. Sometimes the taxpayer may not want to risk selling a good property for something unknown. So they don't want to risk not being able to find something that's going to be suitable as a replacement property. And here they are, they've closed on their sale and they're scrambling to try to find something. And sometimes that's when a decision is made to invest in something that maybe they don't necessarily want, but they're trying to make the exchange work. And usually, I shouldn't say, I was going to say sometimes, but usually the seller of the replacement property wants to close before the sale of the relinquished property closes. So most sellers are going to be unwilling to have the closing of their property contingent on the taxpayer's relinquished property closing. I've seen some clients maneuver that and are able to work that out, but most are not able to. So it just gives, again, clients the opportunity to secure the replacement property for their exchange before they've actually closed on the sale of their existing property, hence the name reverse exchange. So it would be important to make sure that when they go under contract for the new purchase, it's really imperative that they add language to the contract allowing for the assignment to an exchange accommodation title holder for the purposes of completing a reverse exchange pursuant to Revenue Procedure 2000-37. Don't worry, we can provide you with this verbiage if you ever need it for a contract, whether it's for yours or if you're working with a client. The point I want to make is it's really important that you include this in the purchase contract, because the standard 1031 verbiage that you will find in some contracts that's automatically in there is not sufficient. We're establishing what's known as a parking arrangement at this point. There is technically no exchange taking place. the buyer, taxpayer, exchanger, whatever you want to call them, is technically assigning the purchase contract to an exchange accommodation title holder. And that title holder is technically taking title to the property. So it's important that the contract allows for that type of assignment. So we would establish the title holder entity that would take title to the property. This is not something that the taxpayer would set up or anyone else. Typically, the QI is going to set up the entity. And it's really important to confirm who's untitled to the relinquished property, because that's going to determine how many entities we are going to have to establish. So we set up one single member LLC on behalf of each taxpayer completing the exchange. So, for example, if I'm doing a reverse exchange and I'm the only one untitled to the relinquished property, then only one single member LLC is established. However, if I held title to the relinquished property with my husband, then we would need two LLCs, one per taxpayer completing the exchange. So once those LLCs are established, we would provide closing instructions to the title agent or attorney handling the closing, advising them of how title will be taken and that this is all part of a reverse exchange. Now, when we establish these entities that take title to the property, we designate the taxpayers as special agents of their respective LLCs. So at closing, each taxpayer is going to sign all documents as special agent of the LLC that we've established on their behalf. And they have to provide the funds for closing, which we'll talk about in a minute. So title to the property, the new purchase, is going to go in the name of the LLC or LLCs that have been established. So the taxpayer is going to provide the funding for the new purchase. They're going to sign the closing documents. But for all intents and purposes, we are taking title to the new property on their behalf in the LLCs that we've established. So this is the part of the conversation where the question comes up. I have an LLC that I set up before. Can I just use that one? Unfortunately, no. It has to be a newly formed LLC that we establish, because the sole purpose of the LLC is to facilitate the reverse exchange, and it needs to be established by the exchange accommodation title holder just to ensure that it is set up properly and pursuant to the RefProc of 2000-37. Second question, well, why do we even need the LLC anyway? Why can't we just take title to the new property? I hear you. It seems a little cumbersome, and it's a great question. But since things are basically happening in reverse order, there needs to be a title holder in place while you try to find a buyer for your relinquished property. So let's look at it this way. If you were to take title to the new property and you have not yet sold your old property, you would have ownership of the old and new properties at the same time. And at no point would there be an exchange taking place. Technically, the exchange itself takes place when you sell your old relinquished property and you acquire the new replacement property from the title holder. So as I mentioned earlier, all we're doing right now is we are establishing what's called a parking arrangement. We're basically taking the property, parking it in this entity for you, and basically bought you some time to sell your existing property. You've just bought yourself some insurance that no one's going to come in, swoop in, and buy the property out from under you. Because if you try to wait to get a contract for your existing property, the property you want to buy is probably not going to be available by the time you're ready to make the purchase. But that's why we have to have the LLC in place. If you buy it directly in your name, there's no exchange that's ever taking place. So funding the purchase. Okay, so when we're talking to somebody about a reverse exchange or being an option, one of the first questions I'll ask is, how are you going to fund this purchase? Now, for the record, we do not provide the funding for these purchases. Now, some people will talk to us and they'll say, well, I thought you do that. No, we will not provide the funding. So the exchanger will have to provide the funds for the purchase, either with cash or financing, or maybe a combination of the two. Because remember, their sale hasn't taken place yet. So we don't have any sale proceeds to apply towards the purchase. So we need to make sure that the client understands you've got to provide the funding for this. And if you need to get financing on the new purchase, it's really important that we talk to the lender and make sure they understand that the loan must be in the name of the entity that's established for the purpose of the reverse exchange. Here's what's ultimately happening. Okay, so we're going to tell the lender, hi, we're Midland. We're taking title temporarily to this property in this LLC name. Our client here is going to be the one guaranteeing any debts that are taken out against the property. They will eventually own this property, but in the short term, we own the property. So we need the loan to be in the LLC name, but our client here is going to guarantee payment of the debt. I'm not going to lie, it can sometimes get a little bit challenging because one, the lender has to be able to do the financing in that fashion and understand the reasoning and the purpose behind it. So what if the bank won't allow that? What if they say, I'll give you an example. Sometimes they'll say, well, here's the deal. We can do the loan, but it's got to go in their name first and then transfer to the LLC. Will that work? No, absolutely not. If the taxpayer takes title to the property even for 1 second, it's that the reverse exchange is blown. It's got to go, the title has to go directly in the LLC name. So if the bank comes back and says, well, we just can't make that work, and the client has no other lenders that they can reach out to, or for whatever reason, they just want to work with this lender, there's one last hope. So if the bank will not finance the new property in the LLC name, they may be able to park the existing property, the relinquished property. Couple of things. The relinquished property has to be owned outright by the exchanger, taxpayer. And the exchanger would have to deed the old property to the QI, technically the EAT, and purchase the new property in their names personally. And this, my friends, is known as a forward reverse. Stick with me. I hope nobody's getting any dizziness from this, but it's a forward reverse. And here's why. Because they still don't have a buyer for the relinquished property. Okay, so we're still technically buying the new property first before they've sold the relinquished property, but they're technically selling, quote unquote, the relinquished property to the title holder LLC, because they are deeding the property to the title holder LLC. They no longer have ownership of it. So what they've done is they've transferred the old property out of their names and parking it into that entity name. So they've technically sold it, transferred it, and that allows them to now move forward and buy the new replacement property in their names personally. I'll be honest, we don't see too many of these specific type of reverse exchanges because it's just simply cleaner and easier to park the new replacement property. And quite honestly, we don't really mention this unless it's absolutely necessary. It's too cumbersome to add those additional steps too, of having to deed the property to the LLC, and if they don't sell their relinquished property, they have to deed it back to themselves. It's too clunky. So it's better to park the replacement property if at all possible. But it's at least good to know that this is an option, because sometimes this may be the only way that a taxpayer can make it work. So, and we have done some, but a very, very small percentage have been forward reverse exchanges, simply because it's just, like I said, it's just cleaner to park the replacement property. Okay, so we close on the replacement property. All right, the clock to complete the exchange officially starts the day of closing on the purchase of the new property. So they have 180 days to close on the sale of the relinquished property. 180 days from closing on the purchase to close on the sale of the relinquished property. And they have to formally identify the relinquished property within the first 45 days. So seems a little bit maybe odd to some people to say, well, of course they know what they're going to sell. Like, why don't they just identify that up front? Most people do. However, there are situations where clients maybe have a couple of properties that they're considering selling, and it's going to come down to whichever one goes under contract first is the one that's going to be put into the exchange. And for that reason, the taxpayer is required to formally identify all possible relinquished properties within 45 days of closing on the purchase of the new property. Now, if the client's a lucky client that's doing a forward reverse exchange and we've parked the relinquished property, then they'll have to formally identify the replacement properties within the first 45 days, just like in a standard exchange. So while the property is parked in the entity, the title holder LLC, the taxpayer is going to be able to basically treat it as their own. They're going to be able to rent it out, collect rental income off of it, but they'll also be responsible for any expenses associated with the property. It really just comes down to, you can treat it as your own, you just don't technically own it yet, because the title holder LLC is the owner of the property. But that won't prevent you from renting it out, collecting some income off of it, or generating income off of it while you try to find a buyer for your existing property. So once the taxpayer is under contract to sell the relinquished property, this is technically when the actual exchange documentation is prepared. Again, up to this point, all we've done is establish a parking arrangement for the replacement property. We've set it aside. It's being held on behalf of the taxpayer. So now that they're under contract to close on the sale of their relinquished property, we'll prepare instructions for the title company and coordinate the transaction just like in a standard exchange. Client's going to sign all the documents just like they would a normal real estate transaction. And at closing, the proceeds from the sale would be wired to us as the QI. Okay, so very similar to just a standard exchange. So what's next? So once we're in receipt of the proceeds, we will apply the proceeds towards paying down any loans that were taken out to purchase the new property, if applicable, or if the client paid cash for the new property, then we would reimburse them for the funds paid out of pocket. That would not be considered taxable boot, because technically what the client was doing up front was loaning the title holder the money to make the new purchase. And so we're basically replacing client funds with exchange proceeds. At the same time, we would transfer the new property to the exchanger. We normally assign membership interest in the LLC to the taxpayer. It's, again, goes back to, it's cleaner, it's easier, and it's for documentation purposes. I think it's clearer for everyone involved and anyone that may review the documentation down the road. Once the LLC is assigned to the taxpayer, then, you know, if they want to change the deed, they probably could. They'd have to make sure that they cover all the bases and make sure that the title policy is going to carry through to the new name, that everything that's in place and currently under the LLC name would still carry forward to the new name, whatever they deed it to. However, they need to be careful and make sure that, let's say they decide not to keep the LLC. They said, you made me get it. I don't need it. I don't want it. Great. Have a deed prepared, but make sure that whoever you are deeding the property to is still the same taxpayer as the one that's completing the exchange. So, for example, if it's me individually completing a reverse exchange, right? And we set up Teresa Noah Real Estate Holdings LLC for the reverse exchange. I'm done. It's wrapped up. Now I'm saying, I don't want the LLC anymore. I want a deed taking the property out of that LLC name and just put it into my name individually. No problem, because I'm technically the taxpayer that was completing the exchange. I would have a problem if I said, I want that LLC to deed the property from the LLC to my corporation or to a partnership that I'm a part of, because now we're changing the taxpayer that's taking possession of the replacement property. Not to say that you can't change the owner on the deed at any point in time. You just need to wait for an appropriate amount of time before making any changes to the taxpayer that owns the replacement property. So, got to make sure if you're going to deed the property out, make sure that you're deeding it to the correct taxpayer name. Hold it in that correct taxpayer name. Usually, most tax advisors would suggest at least 1 to 2 years to satisfy intention. And then after that, if you want to pursue deeding it into a different entity name or into different names, you could pursue that. But we want to make sure that we preserve the integrity of the exchange itself. So you don't want to make any changes to the taxpayer that's taking possession of the replacement property. So I mentioned earlier that, insurance coverage, title insurance specifically, you want to make sure if you're going to change the name on the deed, make sure everything that's in place will remain intact and in effect if you make any changes to the owner of on the deed. You also want to make sure for property insurance, when you are obtaining insurance on the new property that's being parked in the LLC, most people will just go to their insurance provider and say, hey, I'm buying this property. I need to get some insurance coverage. I need liability coverage, all that good stuff. Make sure that the LLC name is also an insured party, not just you individually as the taxpayer. Because remember, technically, you don't own this LLC yet. Yet, you will, but you don't own it yet. So make sure, and we provide some information to clients on this about how they need to make sure the insurance coverage is drafted and who should be listed as insured parties. But that's something to keep in mind. Again, the contract must be assignable, and you want to have that additional verbiage in there, referencing the possibility of assigning the contract to an exchange accommodation title holder. Financing issues, we touched on that, about how some lenders may not be able to do the financing in accordance with the requirements of the reverse exchange. So this is not something that can be done at the last minute. You definitely want to get your ducks in a row, start having those conversations early on. Ideally, you would know kind of what your plan of action is before you even go under contract for a purchase. I realize that's not always going to be the case, and sometimes that's not what the original plan was. But you definitely need as much lead time as possible to make sure that everyone's on the same page and that you can get the reverse exchange set up in plenty of time for closing on the purchase. And then moving forward, if you keep the property in the LLC, some clients like it, they want to keep it. Just remember, there's going to be some ongoing responsibilities in terms of maintaining the LLC and making sure that the annual filings are done and any updates to the management are completed each year. So let's look at another scenario, okay? Let's say that Dave is selling an investment property for $600,000 and is scheduled to close on April 15th. So he's already gone under contract for his new replacement property for $1 million and is scheduled to close on April 30th. He has another property that he wants to sell in this exchange, but it's not even under contract yet, and it's valued at approximately $400,000. So he'd be selling a total of $1 million worth of property and buying $1 million worth of property. He wants to know, is there some way of including that second sale into the exchange? He may be able to do this by structuring a combination of a reverse exchange and a forward delayed exchange. Okay, so I'm going to break it down into two phases for you. Phase one is your standard or delayed exchange, regular exchange, however you want to call it. It's the standard exchange where you sell first, then buy. Okay, so the details from the previous slide said he's got his $600,000 property closing on April 15th. Okay, so he sets up an exchange for that. Proceeds come to Midland. And now at this point, Dave needs to allocate a percentage of the new property on behalf of the standard delayed exchange. He needs to identify what percentage of that total value are you identifying on behalf of your standard exchange. The math's pretty easy for this one because he's selling and buying for $1 million. So he's saying, okay, well, this one's 600,000. So I'm going to identify 60% interest in the new property is going to be purchased by Dave directly as part of the standard exchange. That 60% interest equates to $600,000 of that $1 million purchase price. We're not factoring in closing costs or anything like that. We're just trying to keep it very, very simple, okay? Phase two is that Dave is going to set up a reverse exchange for the remaining percentage interest in the new property purchase. So what we're doing is, as we've just outlined in the first section of this presentation, we're going to establish a parking arrangement for the remaining 40%. So we do the documentation for the reverse exchange, and then Dave would have 45 days from closing on the new purchase to formally identify his relinquished properties on behalf of the reverse exchange. Dave would have 180 days from closing on the new purchase to close on his additional sale. So you had phase one was the standard exchange. Phase two is the reverse exchange. So the deed for the new property is going to technically have two owners. It's going to have Dave Owens as to 60% undivided interest, and then the Reverse Exchange Real Estate Holdings LLC as to the remaining 40% interest. That's the percentage interest that's been allocated or designated for the reverse exchange, because he's trying to sell his $400,000 property at a future date. And so what he's basically done is identified 40% in this property as his replacement property for a future sale. So when it comes time to fund the purchase, what'll happen is Midland 1031 will wire the 1031 exchange proceeds from phase one, sale number one, the $600,000 sale. And then Dave Owens will technically loan the title holder entity the remaining funds. He's going to provide the funds for the remaining 40% interest in the property. So at closing for the new purchase, phase one, which is the standard exchange, is done because he acquired 60% interest in his name. He equalized the exchange or sale, the sale of $600,000. That exchange was equalized when he acquired his 60% interest. He's done. Now, phase two, the reverse exchange, the second clock starts. Remember, we talked earlier that the clock starts at closing for the new purchase. So he has 180 days from closing on the new purchase to close on the second sale. Good news is he's already identified what he's trying to sell. But if he had multiple properties that he was trying to sell, and it was going to be a situation of whatever goes under contract first is what I'm going to put into the exchange, fine. He just needs to make sure that he identifies that within that 45-day period from closing on the new purchase. And again, I want to stress it's important to remember that the contract for the new purchase must be assignable to allow for an exchange accommodation title holder to take title to a percentage or all of the property. you got to make sure that's in there because the standard 1031 verbiage does not cover that. I realize this is a lot to digest, especially late in the afternoon. But I guess what I want you all to know for today, for the purposes of this webinar, is it is possible to get creative and to combine some things where you can combine a standard exchange and a reverse exchange and really take advantage of maybe a higher value replacement property. It does come up more often than you may think, particularly as clients start to think about, well, okay, the properties that I'm finding are way more expensive than what I'm selling for, but hey, I've got another property that it's on the market too. How can I somehow make this work? So just knowing that it's possible, it's not always so black and white in terms of what you can do with these exchange strategies. That's all we want you to be aware of, and that's all we wanted to show you today. So the moral of the story is, yes, you can buy first and then sell and still do an exchange. And you can, if you're really feeling adventurous, you can get creative and you can combine standard and reverse exchanges or reverse improvement exchanges, or however you want to do it. Don't be afraid to ask questions, and don't be afraid to come up with some out of the box scenarios, because sometimes they may work, or we may be able to provide you with an alternative strategy that might work just as well. So that covers my presentation. I think, Brenda, we can open it up now for questions.
Yes, we can. So it looks like we do have one question already in the chat, in the questions box.
Mm-hmm.
So if you do have any more questions, add them there. Otherwise, I'm guessing Teresa just did so well at covering it that you have no more questions.
We'll go with that.
So for the question that we have, what assurance does taxpayers have that the QI will relinquish property, or if they go out of business before it is completed, what happens?
Okay, so that's a great question. Part of the documentation that we provide to the client doing the reverse exchange is a pledge of membership interest, where we basically sign this document pledging that all membership interest will be transferred to the taxpayer at a specific time, usually on or before the 180th day or upon closing the relinquished property sale. Additionally, they can have an option to purchase recorded with county records, basically outlining that they are the ones that have the option to purchase this property that's being held in this LLC. And some people like that route because they can have it recorded and it's in the official records. I mentioned earlier we're bonded and insured, so that bond and insurance coverage would protect the client in the event that, God forbid, we go out of business or something happens. But the other documentation in place would also give them further insurance as to their claim to the property, or that this property technically is going to be theirs at some point in time, and we can't sell it out from under them. It's their property for all intents and purposes.
All right, great, thank you. So what is the standard cost for a standard exchange and for a reversed exchange?
Okay, so a standard exchange will typically cost $995, and a reverse exchange from start to finish would cost $4,500.
Okay. All right, if I buy first, I have relinquished my existing property. Do I have a time limit on selling the existing property?
Okay, so I think okay, so if you buy first, then yes, so we would take title to the replacement property. So the closing for that new property is when your clock starts, and you would have 180 days from closing on that purchase to close on the sale of your existing property.
Okay.
I hope I understood the question.
I think you did. It looks like it.
Okay.
Okay, so that looks like all the questions we've received for today. So if anyone does have any more questions, they can reach out to Teresa directly. I'm going to be sending a follow-up email along with the recording of this webinar once this is over. But aside from that, Teresa, thank you so much. You were amazing. And thank you all
Thank
for coming.
you. Thanks, everybody.